All communications are from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Everything contained in this webinar, including the live trading room, are not to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. All right, so let's get over to some charts here. I know that's why everybody's here. Tonight's topic is spotting trade opportunities quickly and getting in and out of the market quickly to make our money. So what I'm going to do is this. Here's how I'd like to approach it. We got quite a few people still visiting us. We're at the tail end of the 2-week visit program that we had. We had the free trial open. We had a bunch of you have come to visit us, and that's cool. And we appreciate that. So you'll get the invitation to the live room tomorrow and the webinar on Saturday. And then basically come Monday, it's going to be back to business as usual. So for those of you who are completely new to us and our program and what we do here at Viper, we mainly trade the futures markets on an intraday basis. So we're not a buy and hold. This isn't something that you sock away in your 401k and you forget about it. Like say you bought some Apple stock and you just bury it and forget about it. We look to take advantage or exploit, if you will, intraday movements in the futures markets. And so let's talk about what you're looking at here. What you see in front of you is a 4-range chart. So each one of these bars is 4 ticks in size. We prefer the 4-range chart over the time-based charts because we used to work with minute charts and 5-minute charts and guidance from a 15 and a 30-minute chart and all manner of different times, all kind of jumbled together. And we just found that what happens with time-based charts is that you artificially constrict. So one bar can be tiny and the next bar is huge. And the next bar is tiny, and the next bar is huge, then 3 huge bars, and then 1 tiny bar. You can't, it's really tough. If you've ever traded time charts, you know what I'm talking about. 3-minute charts, 5-minute charts. So a long time ago, many, many years ago, like 8, 9 years ago, we decided to go with range bars, and we've stuck with that ever since. So everything you see here is going to be a range bar. Now, if I took all these indicators off of here, you would just see plain bars. It would look nothing like this. So what we did is we said, well, we need something visually to help us see where the trades are. Visually, we need to see where the trades are. So the first thing we put in was we put some bar colors in. And we said, okay, that looks good. That's helping us. And we opened a live room, and we invited some people in, and they started liking what they saw, and we added some background colors. So here you can see when a market's going up, generally the background's green. You have predominantly blue bars, and the market's stair-stepping up. So that's one of the main things we want to do when we look at any market. And let me just flip around between markets here for a little bit until everybody gets settled and comfortable with what we're talking about. So this is the NASDAQ futures, NQ. All of the equity contracts, which is the E-mini S&P, EMD, YM. I'm going to shift to YM here. This is the mini Dow futures, are all under the December contract. So what we do here is, if you're ever wondering what the latest contract is for futures, you would go to what's called the CMEgroup.com. They're in Chicago, and that's where the markets clear. Most of the brokerages are located in Chicago, and the website looks like this. This is where the futures exchange occurs, CME Group in Chicago. If you scroll down to the middle of their web homepage here, you'll see on the equities, here's the E-mini S&P contract. That's $12.50 a tick. Here's NASDAQ, NQ. That's $5 a tick. They're all on the December contract. So just before the December expires, then we'll roll to March. So it's every 3 months. So in that sense, it's somewhat a little bit like an options contract in the fact that it expires. Here's YM, the mini Dow, And the other one we like to trade, of course, is the RTY, which is the mini Russell. Now, if you remember, the Russell used to be TF, and it used to be on the ICE exchange, and it used to be $10 a tick. Well, that all changed about, I don't know, maybe 4 or 5, 6 months ago. The CME group started listing the mini Russell as RTY. You get that through your data feed now, and it's also $5 a tick. So what that means is that each tick of movement here is worth $5. So if you go 10 ticks, it's $50, et cetera, as the market moves. Now, one thing that's important to notice is that all markets are not the same. In other words, each one has kind of its own personality. Some are a little more whippy than others. Some run further than others. The E-mini S&P, as most of you probably know, it's highly traded by a lot of algorithms, so it doesn't move around a whole lot during the day, heavily institutionally traded. Some are smoother than others. Crude oil, for instance, you've seen crude oil in our room, CL, that's $10 a tick. Let's go ahead and pull a crude chart up. So what you want to do as you're starting to explore getting into trading the futures markets is you want to try lots of different instruments. You want to bring lots of different types of instruments up. You want to bring the Russell up, play around with that for a while. YM, you can see here that oil looks a lot different than YM does. It's a commodity, so it's different. It's not an equity market. You know, there are times when these markets you can see consolidate. This is the predictors. These large sort of bubble-looking things are predictors. That's showing where support and resistance are. Yes, Avad. On a 4-range chart, all the bars are 4 ticks. So when you go that 5th tick in a movement, so let's take a bar. Let's take a bar. Look at just a random any bar. It doesn't matter. So as that bar right there was forming, it's 4 ticks, 4 ticks, 4 ticks. When the 5th tick comes in, if it ticks down, then the bar goes down. If the bar ticks up, then the bar goes up until another 4 ticks, 4 ticks, 4 ticks. And of course, that's how all these bars are formed. Now, if I was to put a 1-minute chart or a 5-minute chart on here, it would look completely different from this, because each bar would be 1 minute or 2 minutes or 3, whatever time frame you have set. Now, what's important to note here is that markets are in basically one of 3 different types of conditions. So what are those conditions? And we have to know what the state of the market is before we can trade it. So let's look at some examples. Here's some good examples right here on crude oil. Now, I'm going back a couple of days. I think this might have been yesterday. I don't think this is today. But here you can see that crude oil, and I'm not talking about any trade setups just yet. I'm talking about just taking a general look at what's happening in a market. In a few minutes, we'll dive down and we'll start talking about actual trade setups, like where the trades are and how to take them. But let's keep it pretty high level for right now. So for instance, over here, you can see on crude oil that you are going up, generally in this area right here. And when you're going up, of course, you have the green background. Bars are predominantly blue. Your band and the mid band, all the bands here, are stair-stepping up, stair-stepping up, stair-stepping up, stair-stepping up. And so what types of trades do we take when the market's going up? This is an uptrend. Excuse me. So in an uptrend, what types of trades do we take? Long or short? There's only 2. Are you buying or selling an uptrend? Buying or selling an uptrend? Yeah, you're buying. You're buying. You're getting long, and you're buying pullbacks. So let me show you what we mean by retracement or pullback. So in financial markets, there is this notion of when you have a trend that you have, let's start over here to the left on this chart right here. you have what's called a thrust. So let's look at some examples of thrusts. Here is a thrust. A thrust is a push in a given direction. And then we have retracement. So we have pullbacks like that. And then we have another thrust like this. And then we have another retracement. So let me ask this question now that you see this. In an uptrend like this, where the market is heading up, do we buy on the thrust part of the move or the retracement part of the move? Do we buy on the thrust part of the move? Are we buying on this part? Or are we buying on this part? Retracements. Good. Retracements. In the case of the long trade here, where we're buying support, we want to see the market pull back into a support area. So in this case, it happens to be right here at the midband. That's why a lot of trades that you hear called in the live trading room are located at or around the midband. The midband is this big chunky middle band in the middle of all the bands here, right? Here's a good way to think of it. Generally, you're going to be looking at an area around the midband where you want the market to come back into. In the case of the long trade, you're looking for a bounce to buy. So here's a good example here where you had a long trade bounce off of the midband to get long. Yes, a little bit of follow through. Got to scalp you out on that. It's not like a VWAP. No, it's our own proprietary indicator. The bands in the midband. Here's another one right here. So here's a thrust, a retrace, thrust, market pauses, and then you get a nice move. So it was a huge move. Now, likewise, on a downtrend, we have the opposite condition. So in this case here, you can see that we had a thrust down through the midband and support like such. So much of a thrust that it actually turned the background red. And you can see here that at this point here that the markets, this was 9:40 I think yesterday. By the way, just a pop quiz, why was oil moving around so much yesterday? Any idea? Why was oil moving around so much yesterday? Let's see, yesterday was a Wednesday. What happens on Wednesdays with crude oil? If you're going to trade crude oil, it's pretty important you know this, right? Yeah, it's crude oil inventory right here. So it's 7:30 Pacific right here. You got crude oil numbers came out right here, 7:30 Pacific. And the oil markets tend to move very, very nicely on Wednesdays. Wednesdays are a good day to trade oil. So here again, we can say that this is a thrust, and now we've gone into what's considered to be a downtrending market, like such. So here's the thrust part of it. Here's the retracement part right here. And then we have a thrust and a retrace and a thrust, and then another retrace, and you can see the patterns continue all the way down. Now, one of the challenging parts about trading this type of system is that you can see here in these examples that, you know, if it always came back perfectly to the midband, as it did right here, and as it did over here, life would be easy, wouldn't it? I mean, you know, we just wait for the market to come to the midband, and we'd either take it long or take it short, and then we just instantly start making money like an ATM machine. But we all see that obviously it doesn't work like that. So what happens is sometimes you get very shallow retracements, and this is where, you know, sort of you know, developing some skill sets around being able to see how far the retracement has gone to get in a powerful moving trend. The retracements can be very shallow and not ever make it back up here. See that? Sometimes they come right to the mid-band, sometimes they don't. Sometimes they'll actually go through it. Yeah, that's what we like. We like the mid-band, but sometimes you have to be flexible and look for other ways to get in. All right, so that's how we deal with an uptrend, and that's how we deal with a downtrend. That's basically the logic behind our entries. Now, what's the other type of market condition we can have? So if a market's not going up and it's not going down, what's it doing? Market's not going up and market's not going down. What is it doing? Remember we said there's three. Isn't there three? There's three types of markets. What's that third type? Sideways. Good. Range bound. Side choppy. Congestion, consolidation. There's different terms and to call it. Let's look at a good example of that. Let's talk through how that happens. So here was our big sell-off over here to the left that we just looked at, and the retracements that happen for the short trades, yes? And then you notice here we get sometimes what's called a little bit of a double bottom. So a market will come down, it'll set a low, it'll come back up, you'll get one more shot at it, it'll try to break it, it can't do it. This is called a double bottom. In other words, the market in crude has found support in this area. That's what a double bottom is. It's found support. There's enough interest of buying here that it is no longer going down, evidenced by the double top. Now, when a market starts doing this in a downtrend, what is happening? What do we call this? There's a name for it coming out of a downtrend. So you've been trending down, shorty, 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 short. Everybody making money. A little bit of a double bottom. Whoa, what's going on here? And then what is this? What the heck is going? Why is it going up here? And then why is it going way up there? Well, let's think about it for a second. So for all of the people and all the traders and all the algos around the world that were short this market from up here and all these places, including you and me and us, if we were trading it, we are doing what when it gets down here? What are we doing to our positions, our short positions? What are we doing down here? Taking profits. And when you take profits, you have to buy your short back. Yes? You're covering your shorts. And so when you cover your shorts, that creates a counter trend updraft like this. That's exactly what this is. This is not necessarily buying per se. But here's the difference you can tell between short covering and buying. Buying is over here. Okay, this is buy programs and market participants all over the world pushing the market higher. That's buying. That's what this is right here. And we talked about how to trade it. The opposite is true over here. We're short, so we're selling. So down here we're taking profits, which means we're buying our shorts back to cover them, yes? And when we do that, it creates that draft, which is going to push the market higher. Now, you tell me what I'm going to advance this chart in real time. We're going to look at it all together here, and we're going to pretend that we're looking at the market, and I'll move it forward about an hour and a half or so, and you tell me what you think the market's doing. Type in a U for up, a D for down, or an S for sideways. Ready? Okay, so your eyes are going to be focused right over here on the right. Right here. Here we go. At any point, you can feel free to type in a U for up, D for down, or S for sideways. So we're watching the markets together here. We're pretending we're looking at it live together. What's oil doing right now? There's midnight Pacific. There's the European session kicking in. Asian session. 2:30 a.m. Pacific time, so we're overnight here. Okay, I'm going to stop right here. Sideways. Good. Range bound. Good. Exactly. Choppy. Consolidation. This is not up. This is not up and it's not down. How do we know it's not up and how do we know it's not down? What are the telltale signs here? Well, unlike when we have an uptrend and unlike when we have a downtrend, an uptrend we have higher highs and higher lows. Now let me do it this way. Let me show you something here. We could put a line right about there, and we could put another line, I don't know, right about here. And we could say to ourselves that as long as the market remains within the confines of these two lines, that we are in a range. Right? We're in a range. We're stuck in a range. Now, high level question. Do we trade a range the same way that we trade a trend? In other words, as the market is in this range right here, do we trade it the same way as we did over here with our uptrend and our downtrend? Here's the uptrend, here's the downtrend. We talked about it, right? So here we are in the range. Is it the same? Do we trade it the same, or is there something different? What do you think? Are ranges traded the same as trends? So we put a mid-band box on here, right? Here we talked about, you said, okay, look for a retrace, Charles. Come up close to the mid-band. We're going to take a trade, right? So let's trade the mid-band here. What do you think? Here's the mid-band. Here, let's go. Let's take a little region box from Object Trader. Let's put a region box right there. There you go. That's good. We'll take a long, maybe take a short. Oh, here's another box right here. You think that's a good idea? Is that how we're going to trade a range consolidation area? We put boxes at the mid-band, right? Just like we do with the trends. So in that sense, ranges are just like trends. No, absolutely not. Absolutely not. So here's the deal. Ranges are completely different. They are the absence of a trend. They are the lack, by definition, they are the lack of a trend. So what we need to do is the first thing, and there's just a couple of very simple steps to determine how you're going to do this, okay? The first one is the size of the range. It has to be at least 20 ticks. That's our rule of thumb. 20 to 25 tick minimum. If it's not 20 to 25 ticks, we're not interested in it. So in this case here, you can see that support was down around 69.70 and resistance was up around 90.95. So is it big enough? Yeah, that's 20, 25 ticks, so it's tradable. Let me take these off of here so we're not trading boxes at the mid-bands. That's not what we're doing in a range. So what you have to do then is that the second thing to do is you have to determine how you're going to trade the range. Are you going to, your primary mode of entry is going to be to short or sell the top and then buy to cover at the bottom? That's how you're getting in and out of here. So each time you're up here, you're shorting it, you're covering it, buying it back. Shorting it, buying it, cover back. Short, you get the idea. Are you going to be buying support? So when it comes in here, your primary mode of entry is to buy support, take profits at the top. Buy support, take profits at the top. Or, so that's sort of a unidirectional strategy. In other words, you're only trading really one side of the range, right? The other way to do it is you trade both. So when the market came up here, for instance, you'd be selling or shorting it. And then down here, you would be buying it back and covering, and then entering a long trade. So you're short, long, etc. inside of the range. And you can use, I'm not going to get into the minutia of the details of the mechanics of how you get in and out of that. We'll save that for another time. We're just talking high level conceptually, looking at a range and how you're going to trade it. So the midband, most of the times, the midband in that retracement strategy with boxes at the midband is pretty much off the table. You're going to have to position Object Trader in a different way to buy and sell the top and the bottoms of the range. And we have to fade the support and fade the top. Fading is you simply come within some amount of ticks. Usually it's at least 5 or 6. So you establish where support resistance is, you establish where support is, you come inside that by about 5 or 6 ticks, and this is where you're buying and selling. So in this case here, looking at this range, and based on what you know, and I'm going to give you 5 seconds, we're going to type in some answers here. Would your primary mode of entry be to sell the top, so S, B, buy the bottom, so in other words, you're buying, every dip down here, you're buying it, and you're taking profits. Buying it, taking profits. You're not shorting. On the other hand, for those of you, that would be a buy, B. If you are a shorty and you're selling, type in an S. So in other words, you're shorting this. Shorting, 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 buying it back. And then if you trade both, go ahead and type in a B. Both. Or type in the word both, because B is for buy. Looking at this range on crude, how are you going to trade it? How are you trading this range? Buying, selling, or both? Now that you know how to trade it, what's your approach? What are you going to do? Sell the top, S, B buy the bottom, or are you trading both? Just type that would be a both. Vote. So we've done our analysis here. We've determined that we are in a range. We've determined that the range is 20 to 25 ticks. That's within our acceptable trading range size. And now we have to determine how we're going to trade it. Oh, interesting. David H. I vote for both sides until my magic 8-ball tells me that there's going to be a breakout and the range is at its end. Good. That is absolutely a good call. My magic 8-ball, I love that. That's pretty cool. Okay, let me show you how this ends. In my view, you could probably let me back up and explain this in a different way. Usually when you have a consolidation coming off of a trend move, you would, generally speaking, continue to trade in the direction of the prior trend. In this case here, we can see that the prior trend before the consolidation here was down. So we were shorting over here. Remember, we were selling the market. It was a downtrend. And so now you're in consolidation after a downtrend. So you should at least be shorting the top. Background, once again, has resumed to red. We understand that even though it's red, we're still going sideways, and you could be shorting the top. Yes. Now, in regards to buying support here and covering your short trade, what I like to do is if a bottom is clearly defined and clean, meaning that all the bars are pretty close to the swing levels, pretty well defined, and it's not one of these jaggedy, breaks way down, doesn't quite get there, and it's this raggy thing that you can't really see a good bottom to, then you probably don't want to be buying that. Okay? So in this case, I would say you could probably trade both, but definitely shorting the top side. Definitely shorting the top side. In a range like this, Havad, you're going to get a lot of yellow bars. Okay, you're going to get a lot of yellow bars. You can see here there's going to be a lot of yellow bars right around the midband here. Like over here, for instance, in the downtrend, you saw that there was a lot of red. Everything's red. Red is down, so we're selling. It's pretty clear and straightforward. Likewise over here, blue and green, stair stepping up. We're buying. Trend is up. We're getting long. Over here, of course, when you're range bound sideways, you're going to get a lot of bars that are yellow. They're going to tend to be clustered around the midband like this. You're going to get a little bit of red, a little bit of blue, and then a lot of yellow. Plus, you're going to notice, I'm going to turn these back on. If you use the predictors, these little oval swing areas, You can see they're going to be located. They're not, see over here, they're coming up and down, right? They're coming down, coming down, coming down. Over here, they're going sideways. So there's lots of things telling you that you're in a range here. And I would say this is a trade, you could trade both sides, and it's very tradable, 20 to 25 ticks. So this was a good range for you. Now I want to show you what happens when you come out of a range. This happens pretty much all the time, and sometimes the last trade will bite you, and sometimes it won't. Let's look at an example of how this range bound situation ends itself. Okay, let's advance the chart together. Here we go. Here we go. Here we go. Uh-oh, what's going on there? Now, I want to explain something to you as you learn to trade these ranges. By the way, okay, I'm just going to say this. You know, there a lot of times markets are in ranges, and so it's pretty important that you have this the ability to trade this type of price pattern. It's pretty good to have that, you know, that quiver, you know, you know, have that in your quiver there. You can you know, take these trades, because if you miss this chunk of trading, you know, here you had 1, 2, 3, 4, 5, 6, 7, arguably 7. This short worked out too. Didn't quite get the bottom, but it worked out. That short right there. Now, if you were using region boxes from Object Trader, and you had put a region box on here to take another short after you didn't quite get here, and you covered the short from here, you didn't get stopped out. If you had a standing sell order here, like a limit order, and you got filled, well, then you got hit at the end. So that's one thing, if you're going to trade both sides, you have to be aware. All right. This is a precautionary tale where we're saying that at some point we know markets are going to come out of their ranges. It's either going to be up, or it's going to be down, or it's going to spike up and then go back into the range like this. So if you had an order here to short this, fading that swing, and you were already short again after you took all these trades over here, yeah, you got popped. And that can happen. If you're trading both sides of a range, the last trade is normally a loser. But the trade-off is you made 7 winners in the middle here. So it's a pretty good trade-off. I mean, even if you got 2, 3, 4 winners in here and you got a pop at the end, you still made money, right? Now I'm going to advance this chart, and this will be the last I'm going to cover on this range thing. And I want you to tell me what you think's going on. Ready? Here we go. Okay, let me stop it there. Yeah, the midband is yellow. That's right. Normally, in a range bound condition, the midband will be flat, and it normally is yellow. Yes. So the first thing that happened, you may have made note of, is that the location of the top and bottom of the range support and resistance levels has changed. Once you broke up here to this swing right here, and you had two conditions where this could not get to the bottom of the range and this could not get to the bottom of the range, you clearly now have an adjustment on the location of the range. So you're still in a range, however, the new location of the range is now like that and like this. It's shifted up. Can everybody see that? Can you see how the range, you're still in a range, right? But now this range is about 10 ticks higher in location-wise than the range over here. So in terms of tradability, yeah, you could keep continuing to trade in the range, but this happens a lot, okay? And that's another thing, if you're going to be a range trader, you have to start really working, pick your instruments that have these ranges like this, practice on it, because you're going to notice that eventually what starts happening is the range will shift. It'll shift up a little bit, it'll shift down a little bit. In the case of this one, with the thrust here up through the swing, it actually turned the background green. Notice that? So over here, we were coming off. Let's recap. We have some people that are coming in still late. Don't worry about it if you came in late. A whole slew of people just came in. Don't worry about it. This is recorded. We'll put it up on the web tomorrow. And everybody will get access to it tomorrow morning, okay? If you have to leave early, don't worry about it. This thing's recorded, and we'll get it up on the web, and you can get the recording. So we talked about over here, yeah, we were coming off a downtrend. We go into the range, and shorting the top was a good idea, and what have you. Background was red. We're still thinking short until we get that pop. Now we get the pop. Once this pop occurs, what does that change? Are we still shorting the top? Is it still a good idea to short the top? Or might we want to reassess the range? Here's the new range setting up right here. We have a new swing here, and we have a new swing here, and it's higher than over here. Are we going to change what we're doing? Are we buying support now? Are we still shorting the top, you think? Think shorting the tops is still a good idea? Like tomorrow morning, you're watching the charts, and this happens on crude. Is something going to change in your approach to the range? Stand by 1 second, please. Yeah, you probably want to be looking at longs, right? You probably want to be looking at buying, and you might want to not consider lightening up on the short side there, because what this is telling you is that it's not necessarily a trend per se. In the fact that we don't, if this pulled back to here and blasted up and then continued up into a green uptrend, yeah, we're in an uptrend. It's a trend change from sideways to up. But in this case, we simply broke through the top of the range and we have a higher swing. So let's go ahead and move it forward again like that. And now it's in an upper range that's located. Here's our support, so we're buying support. Here's our resistance. So we're taking profits up here now. In my view, we'd be buying in here. Buying, taking profits. Buying, taking profits. Now in this case here, of course, you can see that we broke out. So what you can do, here's how you can handle this. If a market is going to break and run as it did here, what you can do, and this will be the final thing I'll say because we're going to go on to some other charts. I don't want to spend all day on crude, is you can put 2 contracts on. And this is a good thing to practice, okay? So you put 2 long, you take 1 off at your target. The second one is reserved for a runner. But what you do on the runner is you put your stop up tight so that if it pulls back against you, you get out of it. Okay, like here, for instance, you didn't get a runner. Here, you didn't get a runner. A lot of cases, you're not going to get a runner, right? Over here, you got the runner. So now you start trailing a stop up. Any questions on what we've covered so far? So we just basically went through the basics. That's a good solid foundation for everybody to build upon in terms of where to look for trade entries. Now let's do a couple exercises together. I want to see how much of this you have retained. I've started doing this over the past couple of months in my webinars on Thursday nights, and people have gotten a favorable reaction to it. And so I think I'm going to continue to do it. I'm going to do it tonight, especially with everybody visiting here. And we have some new folks with us. And I'm going to do a series of exercises. We're going to do some exercises together. The first set of exercises are going to be pretty simple. And then I'm going to make them a little bit tougher and a little bit tougher, because the market isn't always just really simple every day, right? It could get complicated. Let me lob a couple of softballs at you. Okay, you ready? Let's take a look at YM here. Okay, let's do a couple of trades together. Okay, I'm going to start the market. I'm going to start the YM chart, and I'm going to start it at 8 o'clock this morning. And I'm going to gradually advance it forward, advance it forward, advance it forward. And when you think you see a trade, when you believe you see a trade that you would take, and for the first time, a couple times we do this, you don't have to say long or short. You don't have to just type in a T. That's all you got to do. As soon as you see what you think is a trade, you're going to type in a T. Here we go. Here's the first one. Let's pretend we're looking at a live market on YM at 8:11 this morning. Here we go. So we're focused our eyes over here. Let me blow it up a little bit more so you get some more bars on there. A little bit bigger bars. Okay, there we go. All right, here we go. Okay, when you see a trade, what you think is a trade, you type in a T. Okay, I'm advancing the chart. This is real time. We're pretending now we're at 8:23, so about 10 minutes into watching the market here. There's 8:24. Okay, 8:25. We're coming up on 8:30. So this exercise is a drill for the team as a collectively as a group here tonight. When you think you see a trade, you type in a T. Let me keep advancing the chart. All right, let me stop it there. Let me pause it right there. So here's the thing. Okay, Dennis, I see your times coming in there. That's good. That's good. Almost everybody in here got this, which is most excellent. This is the kind of exercise we need to do yourself with your own market replay, and we do these together, and we do them in the live room, right, where we work together to see the trade setups, and we take the trades together, right? So here, for instance, we started our exercise over here at 8:11, remember? So this is where you started looking at it. As I advanced it, there was a few of you, and I'm not going to type any name. I'm not going to mention names, but there was a couple of you that typed in T when the market was down here somewhere. I saw a T. I saw a T come in here. So I just want to be clear. I want to be extra clear with everybody that this was the thrust part of the move here, right? We're thrusting down. The trend is now down. We are looking to sell short on retracements, right? So this is where traders get into a lot of trouble. What happens is this. The psychology is pretty straightforward. You know, market starts to go down, market's going down, market's going down. Somewhere in here, as the market's dropping, you get convinced that it's just going to tank and you're going to make a ton of money on a short here. So you press the button. Or maybe you wait till here. Or maybe you wait down till here. Now you're convinced this thing is tanking. I better get in. It's the next big move. I'm going to miss a 100-tick move, and it's going without me. Sure enough, as soon as you get in, next thing you know, the market moves in your favor a little bit. You're feeling pretty good about the short. All of a sudden, wait, and this starts to happen right here. And you say to yourself, you know what? This happens to me every stupid time. It's like they know when I'm getting in, and they know where my stops are, and they're going to go all the way up, and they're going to get my stops and stop me out. Darn it. Again, same thing. How does that keep happening like that? Well, what's happening is you're getting it at the end of the thrust moves. You have to wait patiently until these retracements occur to pick your spots. Because in actuality, this short trade actually set up way up here. If you were going to short it, you should have put a region box either there or here. This is where the short actually set up, right? When you look back at a trade, that's one good exercise I think that everybody should try to do, is you want to look back and say, where did the trade start? Am I in a thrust? Am I not in a thrust? Am I in a consolidation or am I in a retracement? Everybody see that? So this is one very powerful thing that you want to take into account. You want to stop getting in on thrust moves and shift your entries to retracement entries. Now, some of you started typing in T's as early as these two bars. When those two bars formed, I saw a whole slew of T's come in, which was good. That was excellent. Because that was an early detection that you have the retracement you need to get short right here at the midband. So you'd throw a region box on it, and then when it broke down over here, you'd be short. There was another slew of T's that came flying in when these bars showed up, which was good. And I see that Dennis has typed in 829 and 843. So let's look at those from Dennis's call. 829 was here. Good. Yep, that's the first slew of short bars at the midband. And he says 843, he sees what he thinks is another setup. Yeah, exactly. Essentially, all of these, each one of these pullbacks that came close to the midband here and rolled over were short entries. Short entry there. Short entry there. Short entries over here. They're all retracements. You know, you're getting short in here, and then of course you can see it turned out to be a beautiful short. All right, good. Everybody did pretty good on that one. Okay, let's do this. Let's do one more. Let's do one more on YM. By the way, does that help? Does that help to visualize things? That little exercise? Yeah, I like doing those. I get a lot of feedback from after I've started doing them. I get a lot of good feedback. That when after we do a few of these together, that when they start looking at live data, the trades start making a lot more sense. So what this is going to help you do, like for instance, tomorrow in the live trading room, when you come in there and you hear the terminology, and Gary says, or myself, or it says, you know, when this thing comes back up around the midband, and I don't know, 22, 823, whatever the number is, and it rolls short, I'm looking to get short on a rollover at the midband. And we say, I'm going to box that in, meaning that we use a region box from Object Trader, right? Okay, let's do another one together. Ready? All right, I'm just going to stick with YM, and we're going to do, this would have been 947 today. Ready? James, we have some webinars. In fact, you should have access. There's several videos that show how to draw a region box. And I'll tell you what, I'm almost out of time here. What I'm going to do, so you don't have to dig through all these videos to find it, Saturday morning, if somebody could remind me, I can do some region boxes on Saturday morning. Okay? I'll get Object Trader up and we'll do some together. When you have time, could you take a look at NQ at 929? Congestion cost me some money. Okay, good. Hey, tell you what, David, let me quickly do one more exercise on Weimer, and then we'll flip to Nazi and wrap up with Nazi. So hang tight there, okay? All right. Okay, so here we go. All right, so here we are on Weimer. We just call Weimer Wymie because it's YM and it's the mini Dow, $5 a tick, December contract. Here we are over here at 9:47 a.m. Pacific time. The market looked like this. Now I'm going to slowly advance the chart, and I'm going to, when you feel that you see a trade, you type in a T. Okay? All right, here we go. So moving this up a little bit here. Advancing the chart. Advancing the chart. So here's the bars coming in. Now you are at 9:56. Observing the chart. Observing the chart. Now you are at 9:58. Advancing the chart in real time. Advancing the chart in real time. Now we are at 10:03 a.m. Pacific time. The market looks like that. Advancing the chart. Getting some more bars coming in here. 10:04 Pacific time. Advancing the chart. Advancing the chart. 10:06. 3 minutes later, from our observations. 10:02. All right, let me stop. All right, now let me explain this, what's going on here, and then explain the reactions that we saw from the team here tonight. We can see that over here that YM was in a somewhat of a little consolidation patch, if you will, kind of stuck at the midband yellow here. However, we can see, so I'm saying I don't necessarily see this as a trade setup per se. However, the thrust move revealed itself with a push higher like such. There were a couple of you, once again, and I'm not going to name names, but some of you had typed in a T when the market was up here. Okay, I don't have to hopefully restate the obvious that you are in a thrust move. This is the push move. How do we know we're in a thrust move? Well, the bars are in this case, the bars were heading up and they're blue and they're stair stepping up. So you are thrusting. The market is pushing in a given direction and it's up. So we're looking to buy retracements to support the trend because the trend is up, right? Now, there was a small handful of you that typed in a T as these three little bars formed right here, which was good. You were the early detectors, if you will, and you recognized the fact that you had bars just sitting right here on this midband. It was just textbook long pullback, right? And then there was another flurry of T's that came in after these two bars painted themselves and these bars came in here. Another slew of T's came in, which is good. That's exactly where the trade set up right there. That was the trade setup. You should have right in here is where you should have typed in a T. And I'm not in here again. I'm not going to name names, but there was a small handful that typed in a T up here. Now, one word of caution in regards to these trades entries. Just like this thrust right here on the initial push out of this consolidation where the background turned green and now we're heading up, likewise, you have a similar situation right here where you had come out of the box and you were once again in a thrust condition. This is definitely not a buy area. This is a no, 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 no. You're too late. You missed it. In fact, you're almost in a similar condition as this. In fact, I would submit to you that traders who got in out of these boxes are already taking profits up here on if you have multiple contracts. Remember we said to pull a scalper off? You ever hear that in the live room? Probably 10 times. Take your scalpy off right here. Well, that's what we're talking about. It popped up 10 ticks and it's at a resistance level. You pop up, you take your first target off, and now you're trailing your stop on what's left. That turned into be a beautiful trade. See it right here? Just a beautiful trade. Got the scalper off. So, all right, before we run out of time, we had a question from David H. on NASDAQ. Let's get over to a NASI chart. Now, I'm running out of time a little bit. I'll do this on Saturday morning too, I'll show you the difference between some of these instruments. The Russell is very different than the NASDAQ. YM's different than NASDAQ. They're all slightly different. Some of them are a little smoother. Some are a little more choppy. NQ is characteristically very choppy every day. You can pretty much count on it. Now, what's the trade-off? You say to yourself, well, if you say thing's a choppy thing, why even trade it? Well, because you can get if you can get through the chop, you can get some big moves on NASI. Sometimes 2 or 3 times the size of the other instruments. So that's the trade-off. Man. Okay, so he's asking about 829. All right, I got a NASI chart here. There we go. 829. All right, let me scroll back and take a look for that trade. Yeah, sometimes when NASI gets in a range, you'll just hear me in the room, and Gary will say it too. We might say something like, okay, look, NASI's in a, it's got support there at 58, it's got resistance up at 66, pick your spots. So when we say that, what are we saying? When you hear the term in the room, you hear that somebody, Gary or myself, we say, pick your spots. What are we talking about? What does that mean? Pick your spots. We just kind of throwing up our hands and saying, oh, whatever. No, what's happening is we are recognizing in real time that that market is in a range and will give you the support and resistance levels, and you can choose to trade it or not, but we may or may not call trades within that range. So that's what that means. Excuse me. Hold on one second. My apologies. I got a little head cold here. So we have a couple of questions coming in. We have one from David H. at 8:29, and we have another one from Havad at 8:11. So let's address the market conditions at those points. So at 8:11 Pacific time, NASDAQ was right here. So technically, at this particular time, between I'd say 8:09, I'd say be from here over, were we still heading up? Right here. I mean, the background's green. I mean, over here, Charles, based on your definition, okay, I'm not putting words in your mouth, but you told us that the bars are blue and the background's green, and it's an uptrend. It's an uptrend. Yep, that's true. From here to here, no question about it. That market was heading up. However, when we got over to here, by this point here, were we still heading up? What is different between, as you look at this area where I'm putting the cursor around it, and this area over here? What's different between these two? Lower lows and lower highs. It's all yellow bars. It looks like it's dropping. Even though the background is green, the bars are all yellow. Could you not visually notice that the market was starting to look something like this? And you've seen the classic pattern. Everybody knows the classic triangle. You make the case that a wedge or a triangle was building, and the apex was located right over in here. I can't remember if we called this. I honestly, literally don't remember if we called this. But you could have actually put a region box on this, and I would have let it go either way. I don't remember if we caught that short or not, because I had actually caught quite a few big moves early. I was very close to my goal early, and so by the tail end of the room being open, I think we might have been closed at that point. But what you could have done is put a region box right on here from Object Trader, and I would have let it go either way. In other words, a close outside to the uptrend outside would mean the uptrend is continuing this way. And conversely, if we got a close, which we did, we got the close down, then you went into a very nice short position here. So my assessment is you're coming off of what was an up move from over here into a descending triangle, culminating in a region box that you could have let trade either way, long or short. And if you did so, you would have actually caught a short here. Now let's skip over to 829. This is where David is saying he got chopped up. Now this is something that NASDAQ does a lot. Okay? Let's come back. In the current condition that it's in, you're coming up on 828. And so David H., I'm going to answer your question explicitly with the following. And I'm going to do it together collectively as a team. Well, Manny, when we call trades out, if you've been in the live room, everybody has seen this. We say we're getting long or we're getting short, and we generally we say either at or near the mid band, or we're calling out a level, actual levels. Like if it comes back up into 63.0650 and it rolls near the mid band, I'm going to short that, or I'm going to put a region box on it and I'll let it go either way. Hold on. By the way, and we would never take this as insulting, just to be clear to everybody in here and everybody listening on this recording. If you're in the live trading room and you're confused about what we're doing, in other words, you feel that you don't know if we're short, you don't know if we're long, You don't know if we're in a long or in a short, or we're getting ready to take a long or a short. Just go ahead and ask the question. Don't be bashful. That live room is built for interaction. We want everybody to talk. We want to talk to everybody. We want to take questions. So if by all means, if you're not clear as to what we're saying in there on any instrument or any call, you just type in, what was that? Are you getting short NQ? Are you long YM, whatever, and we'll immediately address it. Okay? But I want to come over here together as a team, and I want to look at what's going on here to answer David H's question in regards to 8:29 a.m. Pacific time on NASDAQ. What is the current market condition? Long, short, or sideways? Let me blow it up. We're looking right here. Are we looking for longs, shorts, or sideways, meaning that we're in a range and we'll trade the range? L, S, or sideways? You just type inside if you think it's sideways. So this is the manner or procedure, if you will, in which we determine what we're going to do. The first thing we do, and maybe I should just explicitly write this down so it's clear with everybody's head. The very first thing you do, well, there's many first things. You can put in lines at support and resistance. There's lots of different things. But one of the primary first things you have to do is assess the market condition. We talked about this for almost, over an hour now. Up, down, sideways. Sometimes it's not clear at the time it's happening in real time, but you have to figure that out, right? You can't, and we've talked about, transitional areas where things are starting to, even like as we did right here, we said technically speaking, you're heading up. You actually had a long trade here and another long trade here, but over here we can see that the market was weakening. The trend is down over here. It's down. Background is red, and so what kind of trades are you looking for over here? Shorts. Going into 8:29, you were looking for shorts. Well, yeah, the midband's pink, but what is the market stair-stepping up, stair-stepping down, or stair-stepping sideways? I'm asking it the current condition. I'm going to advance this chart, and that could change, right? So we always know that this is not a static thing, right? It's not a static thing. It's not like taking something like a piece of concrete, putting it on a foundation, and there it sits for another 25 years. Markets are the complete opposite. They are fluid and dynamic. They're constantly changing. That's why assessing the market condition and being right about it is so important at any given point, because it can change. 5, 10 minutes, 2 minutes, a minute later, this could not be true anymore. So let's advance the chart together. We're all in agreement that over here the market's down. Right? You're looking for shorts. As far as this area going into 8:29 on NASDAQ is concerned, the market is down. You're looking for shorts. Let's continue. Okay, now. So now we're at 8:35, 8:36, 8:37. So you're about 7 minutes into your question, David H. Is the market trend still down, up, or sideways? Right now. Here. Right here. I just advanced the chart 9 minutes. Current market condition, up, down, or sideways? Two seconds. Everybody in here should be instantly looking at this and knowing what you're looking at. If you aren't, we need to practice this some more. It's down to sideways, right? So just to be clear, when we say down, we are saying that if the condition is down meaning it's heading down and where there's no question about it, then it's going to look more like this area right here, right? Bars are going to be red stealth, bands all stair stepping down, retracement, you should get theoretically a rollover, but here we started to go sideways. You had a legitimate short here. Whether you had boxed it in here or you had shorted a rollover up here, just because the bars are blue, that doesn't matter. It's still a downtrend. You had legitimate short entries here, no question about it. In fact, you got a scalper off here. However, we're not getting a very clear follow to the downside. So in other words, it's not breaking and tanking like that. So in answer to your question, David H., there was a shorting opportunity at 829 and 830 that you could have taken, and you were looking for follow through that at this point here you really never got. You got a scalper off. You could have if you entered in here. Now I can see where you might have got chopped up a little bit in here because you might have been interpreting this as a potential trend change, or it's not breaking down, or this might have been a little confusing to you. So let's advance the chart a little bit more. How about now? Did you get short too early and you stopped out? Is that what it was? Did you get short down here? He's saying he got stopped out. Okay, well, see, that was the problem. Yeah, that's a problem. If you're getting short down here, you're getting in too late. And then when these retracements are going to kill you. Yeah, you have to do, and this is true of whether you're buying support on an uptrend or selling short on a downtrend. You have to do it at or near the apex of the retracement itself, which is over here. It's like that exercise we did before where you said type in the T. If you're typing in a T down here, well, then you're going to be in trouble because this is not the T. The T is not here. This is not the trade. The thrust part of the trade setup was up here. This is already, by the time it gets down towards the bottom of the here, it's already in the thrusting part of a down move again. Now, granted, it didn't follow through and break, and you're starting to go sideways, but you're still down to sideways. And this is where people are getting out of scalp trades. People are starting to take profits who shorted up in here. Yeah, that's a challenge. So David is saying I didn't see the range forming in the early stages. I thought it was just a retracement of the original trend down. So that's why and I'll spend more time on Saturday on this. I promise everybody here. Okay, this is the challenging part about trading. When there's an old saying most of you probably heard that goes, everybody's a genius in a trend. Okay. Everybody's a genius in a trend, okay? I could show you chart after chart where it's going up or down, and we're all geniuses, right? We're all buying perfectly support. We're all making good money. It's when you get in the middle of this mindless chop that starts going sideways where you're starting to doubt, is this a trend change? Is it going up? Should I buy support? Am I shorting the top of this thing? You got to make it through these areas right here to get the good stuff. I don't know any other way to put it other than that. Now, if you get in here and let's say you take a bad trade and you get stopped out and you're honest with yourself and you say to yourself, you know what? Truth be told, Charles, I have to admit I'm really not that good at trading ranges. Then what do? That's an actual question. That's not rhetorical. If you know yourself and you know your instrument and you know you're not good at trading ranges and it's in a range, what do? Do you keep trading it and taking the hits and losses and more stop outs? Is that a good idea? You stop trading. Don't trade it. Yeah, put it in sim. Don't put your live money at risk anymore in there. Not everybody is a good range trader, and it's perfectly okay. I mean, there's ranges I don't even trade, and I've been trading 25 years. Not everybody's going to be perfect at every type of trade entry. You have to understand that about yourself. You got to know yourself. And if you're not good at ranges and you see a range in real time, you're like, ooh, I'm going to wait. I'll look at it. Yeah, there you go, Doug. Look at another market. Go take a look at gold. See if crude's moving. See if Weimer's getting the move underway. Maybe the Russell has something going on. Maybe everything's sideways. You just got to sit on your hands for about 15 minutes. So just to wrap up, what I'm saying is this, is there are market conditions that are conducive to your trading style, and it's really important that you figure out what those are as quickly as possible and exploit them as best you can to make profits and money in the market. And there's times where you're not in sync with the market. Maybe it's a range that's choppy. You take a stop out, you recognize what's happening, and then you stand down. Discipline and self-management is really what that comes down to. All right, I'm going to go ahead and stop the recording.